Good day to all. This will be our continuation of discussions involving considering fraud in our audit. So this is now objective number 4, identify corporate governance and other control environment factors that reduce fraud risk, because supposedly internal controls should be able to help combat against fraud risks and chances of happening fraud. So for corporate governance is basically a broad course, and that is one subject, in fact, or course in the curriculum for colleges and universities in tertiary education. So hopefully you're able to have such. These are ways by which the company or business, especially the management and those charged with governance to oversight and would pave the way for reduction of fraud risks. Number one is culture of honesty and high ethics. If people really are aware that the company is investing into being honest and being ethical, that would help. Second is management's responsibility to evaluate really the risks of fraud. That's also one thing. And finally, there is audit committee. As said a while ago, it should be members of the board of directors who are basically not doing any line functions. They're not part of the main line of operations of the business. Next to that will be the elements for code of conduct. This can basically also help the organization or business. And then in the form of organizational code of conduct as a whole or as a business, then for the general employee or employees, what if there would be conflicts of interest, how to solve? But normally we should focus with what would be the best for the organization of business, especially for employees, since we're employed to do our jobs for the sake of the betterment of the organization. What about if there would be outside activities, employment, and directorships? So what would be the guidelines to do? Normally, there is the employee manual for that. Then after of which we have relationships with clients and suppliers, what should be the treatment, gifts, entertainment, and favors. Normally, if we receive this as sort of token or appreciation, that's fine, and it should be just limited to that or just part of something that is not that valuable to the point that we are now going to sacrifice the decision that should be properly made. I said that because there are really some of the clients who would really provide gifts, only those gifts of the normal things or situations. Then kickbacks and secret commissions, normally we should avoid and should be avoided at all costs. Organizational funds and other assets, how to keep them properly. Also, organizations' records and communications, especially with dealing with outside people and even within organizations. Prompt communications or communications should be given right away with certain range of time or time frame. Also, privacy and confidentiality. In an organization, there are certain information that can be shared by those people internally, but only certain people can access confidential information without the organization. All other else, external people cannot gain access of such information, knowing private. Then these are organizational factors contributing to risk of fraud. Number one, inadequate internal controls or compliance programs. For internal controls inadequacy, that's very big, 66%. Compliance with accordance to laws, regulations, company policies, that's 49%, but still a contributory factor for that, for fraud to happen. Next is management override of internal controls. We can see that with this, the percentage of survey respondents indicating that factor contributed to fraud, the gray is 2009, while the blue is, or light blue or sky blue is 2003. So we can see that from 2003 and 2009, the contribution of the first increased. Also, for management override of internal controls, management can just click the finger and change whatever internal controls have been contributed and have come out in the operations of the business. Next is inadequate oversight by directors over management. It also increased. Collusion between employees and third parties, meaning they agree to perpetrate or commit fraud. Eventually, it decreased. And because of other factors that increased, of course. What about employees and management? So internally, one is involving internally and externally. This one is really pure internally. It increased. And this is based on our source fraud survey 2003 and 2009 by KPMG Forensics. And then this is an interesting figure and illustration though. After that, we develop responses to identified fraud risks. So in this, we have to change the overall conduct of the audit to respond to identified fraud risks. Also, audit procedures must be aligned to that certain purpose and change, and then it would address the risk of management override of controls. Then number 6 is recognize specific fraud risk areas and develop procedures to detect fraud. For specific fraud risk areas, we have the revenue and accounts receivable fraud risks. So these are normally the items that would have fraudulent financial reporting and misappropriation of assets. So sales would be one to increase profits, and accounts receivable, of course, could also be one to enhance our current asset section. Also, the inventories could be that the inventories are still reflected as higher amounts, but actually the inventories have been misappropriated. Also, purchases and accounts payable fraud risks to show that there would be higher inventories, and accounts payable would also be there, and other areas of fraud risks. Now, this is an effect of fictitious receivables or fake receivables on accounting ratios. Examples on accounting ratios based on Regina Vacuum Company. Now we have to take note that AR turnover is net credit sales divided by average ending accounts receivable. That's our complete formula. So if we are going to compare, by the way, the years are from 1986, so right most part to 1988, left most. And then we can see that our sales have increased, which is okay or fine initially, which would also result to higher cost of sales. But gross profit, despite the change, would be eventually equal. And in terms of percentage, supposedly, but if there are also changes along the way, they would change. Gross profit in pesos would really vary, but you can see the increasing trend or the increasing trend. Our accounts receivable as well. So with this, probably because of fictitious receivables that have been created along with the sales that have been created. If no change on our cost assumptions, normally our gross profit percentage would be the same or very close. In fact, we can see the leap of the percentage from 1986 to 87 to 88. 87 and 88 is quite close, but 1986 to 87, that's really big leap or jump. If you are going to compute that, the difference is at 4.6%, comparing 1988 with 1987, that is 3.7%. What about an inventory turnover? Oh, for AR turnover, we can see that there's also a decrease of that, knowing that despite the increase of sales, that also contributed to increase of accounts receivable. So overall, decrease AR. Inventory turnover is the ratio of cost of sales divided by our ending inventory. Take note also that our figures here are annualized. It's also true for sales and accounts receivable for AR turnover. Now we can see here that for Crazy Eddie Incorporated, our sales increased as well as cost of sales from right to left. Of course, that's the movement. Gross profit increased, and the gross profit percentage from 85 to 86 increased but decreased, interestingly, from 86 to 87. Then year-end inventories increased or upward trend. Inventory turnover decreased. Well, cost of sales actually increased, but then again, just like AR turnover, the ending receivables increased, here ending inventory increased. So that's why the inventory turnover decreased. And that's the reason if you're not going to analyze for AR turnover, it will be that our average collection period, because of the decrease of turnover, would now increase. So it seems that it takes us more time to collect the receivables. This is just in connection to financial statements analysis. But for inventory turnover, it would result to higher average age of inventory, meaning the time it takes for us to sell our inventories would be bigger or would be more days. And number 7 is understand interview techniques and other activities after fraud is suspected. So we can see here fraud detection methods for companies with and without hotlines. And without hotline is gray, sky blue is with hotline. We can see that fraud detection would be lower for tip management review for without hotline, as well as external audit. So those 3 would be lower if without hotlines. But for our internal audit, interestingly, it's the same. And then lower for without hotline, well, as explained a while ago, but greater without hotline if by accident. Fraud detection, of course, is by accident, which is quite unique. And then our document examination also is greater even without hotline, and surveillance and monitoring, well, because it is done within the company. And these are the initial detection methods for $1,000,000 schemes based on the 2010 report to the notion rather on occupational fraud and abuse. So it's somehow not clear. From Association of Certified Fraud Examiners 2010. The font is quite challenging to see. Now, types of inquiry techniques. We can ask questions in order to get information involving, once again, fraud activities and suspicion or suspecting fraud to happen. So we can have informational types of inquiry, assessment. So we are going to perhaps assess really the situation involving our employees and management, listening to certain conversations, evaluating responses coming from people, interrogative, or really ask thought-provoking and probing questions, and observing behavioral cues or certain actions or gestures coming from people would normally provide certain information from them, although not all the time. Like, for example, if a person cannot really look straight at you, so that person perhaps is not really telling the truth in a way. Or if a person is straight in telling the information, then that person normally has already prepared a script involving possible or probable questions. But if there could be some sort of stammering a little bit, not most of the time, then the person could be telling the truth. Those behavioral cues or gestures. And then these are the examples that I just mentioned a while ago. Observing verbal cues during inquiry. Example would be extensive use of modifiers such as generally, usually, often, normally. So our implication, we should probe further if ever the use of the modifier indicates that there are exceptions to the processes or circumstances being examined. So very interesting in terms of implications. Frequent rephrasing by the interviewee of the auditor's question. So may clarify, sir, is this the way that you would like to ask me, or is this what you mean? So a lot of rephrasing. In that case, skilled auditors would know that interviewee is uncertain about his or her response or is attempting to stall for time. Then number 3, filler terms such as well, to tell you the truth, etc. To the best of my memory. So be alert for filler terms as auditors. Then it would suggest that the interviewee is hesitant or unable to respond to the inquiry. Number 4 is forgetfulness and acknowledgements of nervousness, such as I'm a bit nervous, or I just can't remember to the best of my memory. And if this continue, auditors should be concerned about the possibility of deception because that person is hiding something. 5th one, tolerant attitudes, such as rather, it depends on the circumstances, and overqualified responses, such as, this is the one, to the best of my memory. Dishonest people are often tolerant towards someone who may have committed fraud. They're doing that, so it's okay, and that's why I'm accepting it, something like that. And reluctance to end an interview because I still have something to explain. And normally, if persons have hidden information, then they're the ones normally who would ask for more time to explain themselves in the process, just to convince that they're telling the truth. What about for nonverbal cues? So physical barriers or physical blocks. These are the barriers set by our interviewees. Example would be they're going to block their mouth with their hands, pens, pencils, papers, etc. Crossing of arms or legs, finger tapping, drumming, so there will be distracting noises, lean away from the auditor or looking at the window. So in that case, the interviewee feels uncomfortable with a specific inquiry. So as auditors, we can be, of course, looking at these nonverbal barriers. Next would be signs of stress. Interviewees under stress may have dry mouth, dry throat, for example, or let's say dry within. So dehydrated, in other words, lips, swallow, or clear their throats frequently with a sound, or fidget, tap their foot, or shake a leg, and many more, many items, sweat or become flushed in the face, avoid eye contact. So in that case, lying could be an implication for that, which can manifest itself physically. All right. So we ended with something interesting. Hopefully you get something also interesting from this session. Thank you very much, and watch out for more videos coming from this channel. Thank you very much.